So when we try to undertake the task of valuing IT on the books, we're trying to figure out how to calculate ROI, or trying to actually put a monetary value on IT. We start running into to a bit of a problem. We start saying, how do we measure it? Well, it turns out there's a lot of ways in the literature that it's been suggested we value IT. There are traditional financial methods, good old payback. Yes, we really do use that. Payback and break even are two of the most popular ways of actually doing financial analysis of IT systems. There's EVA, economic value added. This is becoming a very popular way of analyzing all kinds of projects, not just IT projects. It's more or less you take the net operating profit with taking into account the system, subtract out capital costs. As you can see, it encourages asset kind of watching. Total cost of ownership is one that was very popular in IT systems like about a decade ago. It still helps us really think clearly through what it means to own an information system. For example, if you own a car, the total cost of owning the car includes your insurance, your registration, maintenance, gasoline, all the things of owning the car. Same thing goes with an information system. Software licenses, maintenance, operating hardware, that sort of thing. It calculates the ongoing cost of owning the thing, and that's really important when you start thinking about whether you want to lease information services from perhaps a software as a service company, cloud computing, or do you want to own it yourself? Other financial methods, total economic impact. That's kind of a uses real options and Black-Scholes. Microsoft has their own rapid economic justification. Kind of scary. Let's do this quickly. It focuses on what stakeholders think are important, creates critical success factors, sees what technologies are influenced by those success factors. You do a cost-benefit analysis and a risk assessment, and that's how you decide whether or not you should use probably a Microsoft product. But then there's some probabilistic methods. There's a set of people who suggest we should use real options. Now, real options kind of make sense, and we use it in terms of thinking about infrastructure investments. When you think about it, in your company, somewhere way back in the distant past, some project was approved and built that included the very first local area network. So that project bore the entire cost of the local area network. However, after that thing was put in place, other projects used the local area network but didn't include the cost or their share of the cost as part of the ROI or whatever method they were used to justify their projects. So Black-Scholes takes a look at some projects and said, look, some of this is infrastructure. It's an investment. It's an option for other projects to be built, and you measure things that way. In one sense, it makes a lot of sense when we're thinking about infrastructure investments. There's some folks have created, and this hasn't gained much popularity, applied information economics, which essentially takes option theory, adds onto it the notion of portfolios, and we'll talk a little bit more about portfolios in just a second, but the idea that you balance the risk of a portfolio with different sorts of projects in the portfolio. You use net present value, ROI, and internal rate of return. We don't see this much too often because it's just hard to do. There are qualitative methods, which are certainly very popular, and the folks at Harvard are pushing balanced scorecard every time you turn around. And balanced scorecard says you should look at 4 parts of a project: the financial parts, the customer satisfaction parts, internal processes, how does it affect them, make them more efficient, those sorts of things, and does your company grow or learn as a result of that? And the whole focus is really on strategy alignment. There's some real pluses about using balanced scorecard when we're looking at strategic information systems and trying to figure out how aligned they are or are not with things we're trying to do. Information economics is a very popular research area IS looks at risks and successes and ranks projects in a portfolio. It's not used very much. Portfolio management itself, you take a look at all of the IT projects that are going on. Don't look at just the costs, but you manage them as assets. And you say, okay, what's the risk of this one? What's the risk of that one? You evaluate them based upon benefits and costs, and we take a look at what the risk of a particular project would be to the company if it fails, and evaluate that. IT scorecard is just like balance scorecard, except it uses kind of IT-centric sort of ways of looking at things. It focuses on growth, productivity, quality, and decision making. I particularly like the decision making aspect of this, because the idea of an information system really is all about supporting managerial decision making. Well, in the end of it, it's all kind of a Tower of Babel. All of these things just, I mean, there's so many different ways of evaluating IT projects. We have to ask ourselves why. There aren't all that many ways of evaluating a factory or a bridge, and that's because information systems aren't factories and they aren't bridges. So there's a bunch of different ways to take a look at information systems, but at the end of the day, they should either make money or save money. And that's what's important. Either way, they cost money. They cost money whether you own the systems or simply consume their value. That's what we have to think about.